What's up, everybody? It's your boy Satt coming to you with today's stock pick, indicator help, and general investment tips. Remember, this channel is all about no face, just facts in 5. I do the research so you don't have to. Shout out to 11 Labs for making every video possible with their next-gen voice cloning and text-to-speech tools. Link in the description and profile. Let's dive in. Today we're talking about one of the most important lessons every beginner investor needs to understand. Time in the market beats trying to time the market. Everybody wants to buy the exact bottom. Everybody wants the perfect entry. Everybody wants to catch the move before it happens. But the truth is, most people lose more money waiting for the perfect moment than they would have by simply getting started, staying consistent, and letting time do the heavy lifting. Let's start with the big idea. Time in the market beats timing the market because investing is not about being perfect. It's about being consistent. If you keep waiting for the exact bottom, you might sit on the sidelines while the market keeps climbing without you. And by the time you finally feel comfortable buying, the move may already be halfway gone. That's the lesson most beginners learn too late. The market does not send you a text message saying, "Hey, this is the bottom." It just moves. And usually it moves before everyone feels confident again. Now let's talk about the mistake, the perfect entry trap. This is when investors keep saying, "I'll buy when it drops a little more," or "I'll wait until things calm down," or "I'll jump in after the next pullback." But while they wait, the market rebounds. Then they feel like they missed it, so they buy too late. Then the first small dip scares them and they sell from fear. That cycle is dangerous because it turns investing into emotional guessing. Waiting for the bottom sounds smart, but most of the time, it just keeps people stuck on the sidelines. Now let's talk about why timing is so hard. Nobody knows the exact bottom. Not me, not the analysts, not the people on TV, not the people on social media. The problem is news changes fast. One day the market is scared about inflation, rates, earnings, or global events. Then one headline changes the mood. Emotion takes over, and before regular investors feel safe again, the market may already be moving. That's why the market often rebounds before confidence returns. By the time everything feels obvious, the easy part of the move may already be gone. Now let's talk about the power of time. Compounding needs time. Dividends need time. Growth needs time. Reinvesting needs time. Patience needs time. Think about it like planting a tree. You don't plant a seed today and get shade tomorrow. You have to give it time to grow. Investing works the same way. The longer your money stays invested in quality assets, the more opportunity it has to benefit from growth, reinvestment, and compounding. The goal is not to be perfect every week. The goal is to keep building over years. Now let's talk about a simple strategy, DCA, or dollar cost averaging. Dollar cost averaging means investing a set amount on a regular schedule instead of trying to guess the perfect entry. Maybe it's every week. Maybe it's every 2 weeks. Maybe it's every month. The point is consistency. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this helps reduce emotion and build a position without needing to predict every market move. It doesn't eliminate risk, but it can help you stay disciplined. Now let's compare timing the market versus time in the market. Timing the market is about guessing bottoms, reacting emotionally, and often missing rallies. Time in the market is about consistency, compounding, and long-term growth. One side is stressful because you're always trying to predict what happens next. The other side is more disciplined because you're focused on building over time. And that's the difference. Traders may try to time entries, but investors need a plan that can survive uncertainty. Here's Satt's take. Patience wins. I'm rating this a 9 out of 10 investor lesson because it is beginner friendly, it builds a long-term mindset, it lowers stress, and it gives compounding a chance to actually work. Now, does that mean you should blindly buy anything at any price? No. Valuation still matters. Risk management still matters. Research still matters. But for long-term investors, waiting forever for the perfect entry can be just as risky as buying too early. The best plan is usually simple. Know what you're buying, understand your risk, stay consistent, and give your money time to work. Remember, I'm not a financial advisor, and this is not financial advice. Do your own research, manage your own risk, and never invest what you can't lose. If this breakdown helped you, smash that like button, subscribe, and drop a comment with the next stock or investing lesson you want me to cover. This is Satt with Stocks by Satt 06. No face, just facts in 5. Keep learning, keep investing, keep building. Peace.